Ray Dalio, a titan in the investment realm with a golden track record spanning 5 decades, recently illuminated a seismic shift in the financial landscape with a once-in-a-lifetime investment opportunity. This pivotal transformation, he argues, is reshaping the very fabric of investment strategies. We will cover several vital economic aspects to understand from financial experts, including Dalio, and more importantly, how this uncertainty impacts you and your money. Our perspective is unique as our channel founder is a financial professional with 2 decades of experience in understanding the capital markets. You will learn a thing or two while watching. Now on to some insights from billionaire Ray Dalio. Dalio's opportunistic insights come at a critical juncture as we stand on the cusp of the 12th and a half cycle since the dawn of a new monetary era in 1945. He sketches a vivid picture of the economic ebbs and flows, from the distribution of wealth spurred by governmental interventions in 2020 to the resultant inflation and tightening monetary policies. With real interest rates swinging from the negatives to a substantial positive, cash, once deemed trash, now emerges as a beacon of attractiveness, offering a safe haven compared to the volatile realms of bonds and stocks. Is cash king? Cash is reigning supreme in the current financial landscape for several compelling reasons. Firstly, the recent surge in interest rates, spearheaded by the Federal Reserve's aggressive monetary policy adjustments, has significantly enhanced the attractiveness of holding cash. For years, investors grappled with near zero or even negative real interest rates, which eroded the purchasing power of cash holdings due to inflation. However, with interest rates now at their highest in over a decade, cash and cash equivalent assets like short-term U.S. Treasury bonds are offering returns that were previously unattainable, making cash a viable and competitive investment option. Secondly, the heightened volatility and uncertainty in the stock and bond markets have underscored the value of cash as a safe haven. As equity and fixed income investments face downward pressure from rising rates and economic uncertainties, cash provides stability and liquidity, allowing investors to quickly respond to market opportunities or downturns without the need to liquidate positions at a loss. Moreover, the increased returns on cash and cash equivalents offer investors a buffer against inflation, preserving the real value of their capital. This shift represents a significant departure from the previous era of low interest rates, where holding substantial cash reserves was often seen as a drag on portfolio performance due to inflationary erosion. Why does inflationary erosion matter? And how can I understand how inflation affects my portfolio? Let's talk real yields. What are they after all? Real yields refer to the returns investors can expect to receive from an investment after adjusting for inflation. In the context of stocks and treasury bonds, real yields give investors a clearer picture of the true value of their returns. For treasury bonds, the real yield is the interest rate paid by the bond minus the current rate of inflation. This is crucial because even if a bond pays a nominal interest rate, inflation can erode the purchasing power of the returns, making the real yield a more accurate measure of an investment's profitability. Real yields on treasury bonds after accounting for inflation soared to levels last witnessed in 2009. Reflecting on the yields of 10-year treasury inflation-protected securities, these real rates in the U.S. reached a peak of 2% before settling at approximately 1.86% by the end of August of 2023. For stocks, calculating real yields can be more complex since returns come from both dividends and potential stock price appreciation. However, the principle remains the same. The real yield would consider the rate of return on the investment minus the inflation rate to determine the actual growth in value. Investors closely watch real yields as they can influence investment decisions across different asset classes. Rising real yields on treasury bonds, for example, can make them more attractive compared to stocks, especially if the stock market is viewed as overvalued or if there are concerns about economic growth. All this information is great, but I need to know more about this once-in-a-generation transformation in the markets. This transformation is not just a blip, but a profound shift, marking a departure from the low interest rate environment that defined the past 3 decades. The U.S. Federal Reserve's aggressive rate hikes have catapulted the federal funds rate to unprecedented heights, fundamentally altering the investment landscape. For the first time in a generation, investors find themselves in a position where cash and cash alternatives like short-term U.S. Treasury bonds not only offer a return, but do so in a manner that's competitive with more traditional investments like stocks or riskier bonds. This paradigm shift extends beyond the macroeconomic level, touching the very core of personal investment strategies. The era of 0% interest rates is behind us, ushering in a new age where holding cash and bonds is no longer synonymous with losing money to inflation. This change compels a reevaluation of investment portfolios, encouraging a more conservative approach that prioritizes income generation and capital preservation. As we navigate this new era, the wisdom of seasoned investors like Dalio and Warren Buffett becomes invaluable, reminding us that adaptability is key in the face of change. The rise in interest rates represents a significant pivot for the investing world and the broader economy, demanding that we recalibrate our strategies to align with this new reality. What does this shift in the value of cash mean for the economy of the United States? Well, a potential recession in the United States is a cause for concern for several reasons based on current data, impacting both the macroeconomic environment and individual financial stability. What should we be on the lookout for, economically speaking? For any savvy investor tuned into the economic risks, it's clear that inflation has been the talk of the town heading into 2024. Peaking at a staggering 40-year high of 9.1% in June 2022, the year-over-year consumer price index inflation has since cooled off to a more manageable 3.1% by November 2023. But there's another player on the field causing ripples: sky-high interest rates. In a bold move to tackle inflation head-on, the Federal Reserve has cranked up interest rates to the highest they've been in 22 years, making significant strides toward its 2% inflation sweet spot. This uptick in rates means borrowing money now comes with a heftier price tag, leading companies to think twice about funding expansions. It also puts a damper on consumer spending, helping to alleviate the demand-driven price hikes. Since March 2022, the Fed has notched up interest rates a whopping 11 times, positioning the Fed funds target rate between 5.25% and 5.5%. The latest hike was in July 2023. With current inflation trends, the bond market is buzzing with predictions that the Fed might switch gears from rate hikes to cuts by March 2024, potentially giving the economy a boost. However, despite the Fed's strides in 2023, a late November peak at the Core Personal Consumption Expenditures (PCE) price index, a key inflation gauge that sidesteps the unpredictable food and energy sectors, revealed a year-over-year increase of 3.5% in October, overshooting the Fed's 2% goal. The final stretch of the inflation fight could prove to be the toughest yet, thanks to the phenomenon known as sticky inflation. This stubborn inflation, evident in sectors like children's clothing, auto insurance, and medical products, is notoriously resistant to monetary policy shifts. While inflation rates in other economic areas are on the decline, sticky inflation could significantly delay the Fed's ability to hit its 2% target and postpone the much-anticipated shift to rate cuts. Additionally, investors need to pay close attention to the dangerous inverted yield curve, because it's often a harbinger of economic downturns, including recessions. Typically, long-term bonds have higher yields than short-term bonds due to the increased risk of holding them over a longer period. However, when short-term bond yields exceed those of long-term bonds, creating an inverted yield curve, it suggests that investors are expecting lower inflation and weaker growth in the future. This inversion has historically been a reliable indicator of economic contraction, as it reflects a lack of confidence in the economy's prospects. Consequently, investors use the inverted yield curve to adjust their portfolios towards more conservative investments to mitigate potential losses during economic downturns. Yield curve inversion has been in place since October 2022, suggesting caution for investors going into the year. Being aware of these potential recessionary factors allows individuals and businesses to better prepare for economic downturns through financial planning, diversification of investments, and building emergency savings to weather challenging economic times. Okay, I get it. I need to be looking at cash and being somewhat cautious in this environment. What should I do? As per Ray Dalio, savvy investors are increasingly looking towards cash or cash equivalents as a strategic investment choice. Among the popular options for parking cash with safety and earning potential in mind, short-term treasury bills, T-bills, money market funds, and certificates of deposit, CDs, stand out, each offering unique benefits tailored to different investor needs. T-bills, backed by the U.S. government, present a low-risk option with flexible maturity terms, ideal for those prioritizing capital preservation over high returns. On the other hand, money market funds, accessible through brokerage accounts, offer liquidity and potentially higher yields than savings accounts, albeit without FDIC insurance, making them suitable for investors seeking a balance between accessibility and yield. Certificates of deposit shine for those willing to lock in funds for a guaranteed rate, offering higher interest rates than savings accounts and the safety net of FDIC insurance at the cost of liquidity. Which investment vehicle do I choose? If you prioritize safety and are investing with a short-term horizon, T-bills might be the best option due to their security and flexibility. If you seek a balance between accessibility and yield, money market funds could be ideal, offering reasonable returns with the convenience of liquidity. For those willing to lock in funds for a guaranteed rate without needing immediate access, CDs offer a compelling choice with their higher interest rates and FDIC insurance. Ultimately, the best choice depends on your financial goals, risk tolerance, and liquidity needs. It's also wise to keep an eye on current market conditions. If interest rates go down, it can significantly negatively impact the attractiveness of these cash options. Although cash is king in the current environment, if you are concerned about a potential meltdown in the U.S. economy, let us show you some of the issues that we uncovered that need to be both understood and addressed for investors. Check out our professional perspective to learn more. We promise you will learn a thing or two and will be more prepared personally and portfolio-wise for the potential pitfalls we are facing. Remember, this is not financial advice. Withdrawal Investing Insights signing off.